and welcome to my real-time options trading, where I trade a real account with real money right in front of you. Now I'm totally transparent as I share my account value live on screen. And I've been trading options online for 28 years now, and I'm here to share how it's possible to trade options with less risk and how you can even follow my trades if you choose to do so. I must say that trading is risky and it is possible to lose money following my trades. My purpose is to help people learn how to trade a proprietary trade I developed called the safe wheel strategy. The wheel strategy, as it's known today, is a popular strategy, but it comes with major risks. And I'm here to help people learn a wheel strategy that does not carry all the normal risks. Now, I've seen people follow the old school wheel strategy that many YouTubers tout, only to end up becoming frustrated and lose money. If you're interested in a conservative, effective approach to trading options for free, you're in the right place. If you're interested in the backtest results of the proprietary safe wheel strategy that I developed, I've made a video on that and I left a link in the description. Okay, let's get started. So, what happened last week? Well, first, before I get into that, I want you to go ahead and post any questions you might have. Start posting those questions right now, because then we won't be waiting till the end of the video, and I'll be able to address your question. One other thing, I do have a safe wheel guideline and flow chart available, which would make what I'm talking about easier. It kind of puts things into context. And I did drop the price significantly on that. I'm not sure how long I'm going to keep the price down on that. So third, I'm going to get into my earnings edge alert account, kind of go over what happened last week and what's been happening with this account. So I go to account statement. You can see that last week we traded Oxy and I made $150 on that trade. So basically my last 4 trades have been successful. And the account is up over $5,000, so I got it back up over $5,000. But I kind of made a couple tweaks, and I think that got the hang of this thing, and 4 wins in a row. So hopefully I'll be having more wins in a row. I just need to win 3 out of 4 times. Okay, so let's get into the safe wheel. Last week, as you know, I have Macy's, and I have 100 shares. And I was selling covered calls, and I sold the $26 call, and I also bought a cheap call. That both of those expired out of the money, so they both went. I got to keep the premium on the call that I sold. And Macy's, I still held the stock, and for some reason, I don't even know why, Macy's popped significantly this morning. I haven't even looked up the reason why. I don't really care. So you can see that the stock is up a couple $100, but then my put hedge, of course, is down. So what should I do? Well, because the stock got over the $26 level, and that's the level that I initially was willing to accept, I'm going to go ahead and sell the stock, and I'm going to close all my positions, and I'm going to start over. So this is like a start over point. It's kind of like a win, it's a win and a start over. So I'm going to go ahead and close out my positions. So I'm just going to right click here, hit closing order. Wow, this thing's just flying up, huh? Okay, make sure I get a decent price. That went quick. And let's see, my put hedge. Try to get as much for that as I can. Mid price 93. Kind of give it a little higher and work my way down. Kind of work this order. Okay, so we're out. We're at 0 positions. time to start over. Up $353 on the year, which is a pretty good percent. Probably a little more than what I expected, probably a little more than what the back tests show, but I'll take it. Okay, so let's start over. What do I do? Am I going to use Macy's again? And my answer is yes. I like Macy's. Why am I going to pick Macy's? Because it's around $30. It has good premium available out of the money. So in other words, I can get more than, let's say that Macy's is trading at $28. I can get more than 28 cents, and I can be out of the money for my covered calls and for my puts that I sell. And it's liquid. It's very liquid. How do I know it's liquid? Well, if I look at some of these options that are expiring, this week, and I go to the at the monies, I can see, look at the difference between the bid-ask spread, 86 and 92. That's pretty tight. I mean, you can get tighter than that. There's more liquid stocks than that, but that's pretty close. I like that, really tight. So they're liquid. Let me address the other thing that I need to address this week. And later on in this week, Macy's will announce earnings. And so some people might think, oh, no, stay away from the stock when it's announcing earnings. That's a typical wheel strategy. Your traditional wheel strategy is stay away. Earnings are coming. With the safe wheel, I'm not worried about earnings. Earnings are good. I mean, I'm going to make more premium. My put hedge might cost me a little bit more money, but it's so far in time, it's not significantly overly priced because of this little earnings event. And that has to do with weighted vega. And weighted vega is a pretty advanced concept. It's basically, I'm just going to give you like the 20-second version of weighted vega. And Ron Bertino did a nice video on that. He went through it pretty extensively, and it's free and it's available. Just look it up. Just put it in the search engine. But think of a dog with a tail. Now, the tail is very flexible and always moving around. That is the closer to, those are the expiration cycles that are getting ready to expire. They're near term. That's the tail. The dog is like the far term ones. So you get a lot of movement and volatility in the near term, and the far term, you don't get a lot of movement and volatility. And that's why I'm comfortable buying a put hedge further out in time, even during earnings. And if that doesn't make sense, the weighted vega concept, very important, and you should check it out. Okay, so what do I do next? I could look at my chart. In fact, I'm going to get my chart out next time and have it available, my flow chart of what to do. But basically, we're starting the wheel process over again. So what do I need to do? Well, I need to sell a put. I need to have a put hedge on, and I need to have a long call to protect my put hedge. My long calls are only like $5. So which put am I going to sell? Well, I'm going to go to the ones that are expiring on Friday, because that's the premium that I sell. And I'm looking at the puts and which ones do I like. We're trading around 28, so it's got to be at least 28 cents. I could go with the $26 put. It is around 28 cents, but I'm going to shoot for a little more premium. I'm going to go to the $26.50. I'm not going to make that trade yet. Now that I know I'm going to do the $26.50, I'm going to determine what my put hedge is. So I'm going to multiply that times 80%. So it's $26.50 times 80%. 26.5 times 0.8. $21.20. So I'm going to buy the $21 put hedge. And I'm going to get it. Where am I going to get it? Between about 150 and 200 days. Here's 178 days. So the $21 put right here, the liquidity isn't that great, but I'll do okay. I'm going to look at the mid price, it's 183. I'm going to buy 3 of these. This is going to be my protection for my next cycle. I just got out of my last cycle of trades. So I'm going to bring this down under the mid price and work it up. Mid just went to 190. Now it's 181, so it's kind of moving around a little bit. And let me show you what I'm talking about when I say the mid. I'm going to go here, right click. Okay, I got filled there. I guess that's got filled quickly. So the mid price, whenever you make a trade, let's just throw any kind of trade in there. You can see the mid price right here. Sometimes it's on this side when you're selling. Anyways, okay. So what do we have? We have our hedge. And now we want to start the wheel. We want to do the traditional start the wheel. So we're going to go ahead and sell. Let's go here to the trade tab. We're going to sell something that's going to expire this Friday. We already decided we're going to sell the 2650. So I'm going to sell this, just one of those. My mid price is 51 cents. Again, because when you're selling, it's on this side. So I might try to get 54 and work my way down. Now just move it 47. So this is the premium that I collect. It's going to cover the hedge cost and end up being profitable overall. Now, it doesn't happen every single time, but it happens in most cycles. In fact, I've ran through 2 cycles now, and both of them have been profitable. And that's pretty normal. It coincides with my back tests. They don't want to give it up. I keep moving this mid price down. I'll go to 48. Talking about an algorithm. The algorithm is when they see your order and then they move the mid price. That's an algorithm. Okay, so we got 47 cents or $47. We need to protect this put hedge. What if the market or Macy's just jumps sky high? Our put hedge is going to take a pretty good loss. That definitely could happen, especially during earnings. So I'm going to go ahead and go to the 3250. And this is where, during this earnings week, this is pretty far away, this 3250. So that might be one little small disadvantage of trading during the earnings. So we're at 6, the natural, the mid 6. So I could go 5 and got it for $5. So that's why you always kind of move it around. Don't necessarily take that mid price. Maybe you can get better than mid. Sometimes you do, sometimes you don't. Okay, so I have my full position on, and we'll see what happens on Friday. I'll come in and check, make sure that Macy's didn't bump up over, what was that, 32.50. Because if it does, I want to sell that call and take in that premium. And let's see. Okay, so let me get to any questions you guys might have. So I'll start from the top. I've already addressed that question. Why don't earnings volatility, why doesn't it matter? With this system, it doesn't matter because I'm hedged. If I was in a traditional wheel, old school wheel, it would matter. And I would not trade around earnings. Let's see here, James. Oh, whoops, sorry. That was this question here. Next question from Edward. Are you looking for a specific delta for the long puts? No, I think you probably asked that question before. I took where my short put was, that strike, and then I did 80% of that. Okay. Why do earnings matter as far as risk of volatility to the upside? So the reason why is because I have a put hedge on, and this hedge right here can lose money if the stock goes too high. And in fact, if the stock did go over 32, and I even made money on that long call, I probably would overall lose money on this particular, I'd be down money on this particular cycle. My puts have obviously suffered a 3-point move up and no hedge for them over the weekend. That's true, but I was long stock over the weekend. So hopefully you were long stock over the weekend. So the long stock overpowered the losses in those 3 puts. And you can see that because I made about $80 just today. And I'm sure that you made money also if you were long stock. If you're not long stock, if you know, it's possible that it could be a problem. But that's why, over the weekend, there is a little bit of risk right there. That could happen. Because you're not long that call. That there is weekend risk, I guess you could say. But you got to take the probabilities and you got to go with it. Okay. I normally let an order sit for a minute to see if I catch the bid. Yeah, I mean, I would do that too, but I'm in a live stream. I think you still have your long shares, and perhaps that would help. But if the put expires on Friday, worthless, you're uncovered. Correct. Yep. And it becomes a probabilities game. And my back tests show that that particular occurrence is so rare. I don't even know if it ever happened. It could happen, but it's pretty rare. Good morning from Lakeland, Florida. I was in Florida 2 weeks ago. Oh, earnings occurred this morning. Okay, I didn't even know that. Doesn't matter to me. It doesn't make any difference with the way that I trade this system. I buy my long protective call on Friday afternoon, the next Friday expiration, and cover the weekend. Yeah, I covered that, talked about that. Please explain again how you determine to close the entire trade and start again. So I closed it because, remember when I sold that $26 put, or I'm sorry, that $26 covered call, that I was willing to be called away at my shares at $26. And I knew that if I was, that I was going to be profitable overall in the cycle, more than likely. I mean, I can't say 100% of the time, but because I had collected so much premium in the past, my put hedge was overwhelmed as far as how much it went down in value. And so once I get called away from my covered calls, that's when I start the whole cycle over again. Now, I didn't get called away because my call expired on Friday, but the stock moved as if I would have got called away. So I took that opportunity to go ahead and close everything out and start over. And why? Because, and we talked about this, I think a lot of people have asked this question, my put hedge gets old and starts depreciating faster, and I want to replace it. And I had the opportunity to do that. Have you considered ROI column on your trade tab? It helps save time when selecting your put. No, I haven't considered that because I just use the the $28 stock, 28 cents or better. So it's pretty easy for me to do it that way. Max, do these simply ratio out in scale? For example, $5,000 versus a $10,000 account. Yes, absolutely. If I was trading a $10,000 account, I would do 6 put hedges, and I would sell 2 puts, and I would buy 2 long calls. If I was doing 50,000, I would buy, what's that, 10 times? I would buy 30 long puts. I would do 10, I would sell 10 puts. So yes, you'd scale it out based on $5,000. And obviously my goal is to move my account from $5,000 to $10,000. Once I do, then I'll start scaling it up. What is your net return before and after fees on everything so far this year? $360. $360 divided by 5,000 is a 7% return since the beginning of the year, which is really good because this thing averages around 10. I'll probably do better this year. I'm pretty sure I will. Okay. One thing I'd like to say in parting, when you're looking at an instructor, If the P&L isn't real, what else are they trying to conceal? Okay, we'll see you guys again next week.